Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for November 2014. Now, when we spoke to you last month, the tanker rates, which had been pretty good in July and August, had started to come down into September. And we said that was a normal seasonal occurrence, that when refineries go back into maintenance, tanker rates tend to drop at the same time. And we thought that that would extend through to October, but that the market would get stronger into the back of November and certainly December, when the tanker market usually peaks. What's actually happened is that the market has recovered a lot sooner than we anticipated, and rates in October have actually been pretty strong for this time of year. So in September, the tanker market was averaging about $15,000 a day across all segments. In October, we've hit about $30,000 on VLs and Suez, and in the mid-20s for Aframaxes. And actually, by early November, we're seeing rates up above $50,000 a day in the VLCCs, $40,000 to $45,000 in the Suezmax, and even in the Aframax sector, we're seeing $40,000 in the Caribbean, $30,000 to $35,000 in other regions as well. So the tanker rates have definitely increased a lot sooner than we thought, and it's a good start to the winter market. And when trying to explain why the rates have recovered as they have, I think it's twofold. One is just the normal seasonal increase in refinery throughput this time of year. Refineries start to ramp up again in anticipation of winter heating demand. But also this year, I think what we've seen is some positive impact from the drop in oil prices. So oil prices have declined by about 25% since the summer, and WTI is now trading between $75 and $80 per barrel, and Brent's between about 80 and 85. And that's positive for the tanker market in a number of different ways. Firstly, it's encouraging the buying and storage of oil, both for commercial and strategic reasons. And in fact, some of the strong imports that we've seen into China in recent months, or in recent weeks and months, is probably due to stockpiling. They've been taking advantage of the cheap prices to get hold of oil, whether it's Middle Eastern, West African, and putting that into commercial and strategic stockpiles. The second impact that lower oil prices has is it reduces the bunker costs. So when you're trading vessels on the spot market, one of your biggest voyage costs is the bunkers. And bunkers were about $600 per ton or more in the summer. Now they're between about $450 and $500, so that's positive for tanker earnings. And then there are some other potential benefits as well from lower oil prices. We see that the futures curve is still in contango, which could create some floating storage. We see there's a bit of a price war going on between different producers, and that's creating some volatility in trade flows. So all of this combines to create volatility in tanker demand. And as we go into November and December, that's then going to combine with the normal winter weather delays that we get. In fact, delays through the Bosphorus are already just starting to creep up to kind of 2 or 3 days through the straits there. And so when you put all these factors together, the weather, the stronger demand through the winter, and the positive impact of low oil prices, we think that it could be a very strong winter market, which has started early in October, and which I said usually peaks around December and January. So I think we're going to see some good rates through the winter months. Looking to next year, we still maintain our positive view that the market will improve on basically no fleet growth in the crude sector, especially the mid-sized sectors, the Aframax and Suezmax, and demand should still continue to grow. However, we have seen some downgrading to the economic forecast from people like the IMF, World Bank, and that's resulting in some lower oil demand forecasts for next year. Also, if oil prices stay low for a long time, we might see some production cuts from somewhere, whether it's OPEC or elsewhere, and that could have a slightly negative effect into 2015. But on the whole, given there's no fleet growth, we still think that rates are going to improve on average if you compare 2014 to 15, and then getting even better into 2016. So that's our summary of the conventional tanker market, and we'll speak to you again next month.